Hi, I'm Tom Porcelli, PGIM Fixed Income's Chief U.S. Economist, and I wanted to just do, as I've been doing, a very quick overview of the most recent FOMC meeting. Look, I think it started out with Powell basically dripping some cold water on the idea of cutting rates in March, and then maybe like 30 minutes in, he just threw a bucket of water, cold water on the idea. He specific, and I have the quote here. He specifically said, "I don't think it is likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that, to cut." So clearly, that's not where his head is. That works out well for us because our head wasn't there either. The market seemed to, look, the market obviously, pricing obviously got dinged on that, but there, last I looked, still about 32% odds of a March cut. I think for Powell, the only way to get there at this point is for labor data to, I think, really sort of get dinged too. So here we are on Wednesday. So Friday, we'll get a payroll report, and we'll see how that goes. But I think it would take quite a bit at this point in terms of labor weakness for the Fed to cut in March. As I think about the meeting in general, the one thing that I would say, so I liked that clarity on sort of near-term cuts. I think if there's anything that I found frustrating, it's this idea of, he kept on saying we want to see more good data on the inflation front before they're comfortable enough to cut. So two things on that. So first, look, we've had a really good run of inflation data. More good data is what we continue to get month after month for the last handful of months, whether it's looking at core PCE or headline PCE, and whether you're looking at it in a 3-month percent change basis or 6-month. It's all moved in the right direction. In fact, depending which of those measures you're looking at, you're even below 2% now. From a headline and in core perspective. So I think that we now have more good data. So point two, and I think that this is going to be the real challenge for him, is the longer you wait for more good data, the greater the risk will grow that restrictive policy will actually do damage to the labor backdrop. We did this as a sort of a very simple exercise. If you just look at policy and how restrictive it is right now, the Fed does nothing, just as an example, between now and June. And we continue to see this sort of this modest improvement, a modest additional improvement, I should say, in inflation between now and June. You're going to be as restrictive from a real policy perspective, right? Real meaning inflation adjusted. You will be as restrictive as you were leading into the GFC. Now, I want to be very clear. I'm not saying this is going to be a GFC. I'm just simply saying that policy would be that restrictive. And in an economy that is slowing down, and Powell acknowledged himself that economic activity is slowing, I think that the risk then of waiting for more good inflation data is that you can actually do some pretty notable damage to the labor backdrop over the coming year, which I think could be completely avoided if they would go sooner than later. So our view remains that the Fed goes in the second quarter. There's 2 meetings in the second quarter. There's a May meeting and a June meeting. If you wanted to twist my arm, I would tell you I think it's May. But again, I think the point for us is I think we're now within a couple of meetings of the Fed cutting, which is what's pretty much been our call.